Hi, it's Arjun. Amidst all this geopolitical and macro turmoil, wanted to take a step back this week and turn back to how should and can companies think about outperforming through all the noise and turmoil that's out there. One cannot be frozen simply waiting for either a calmer time to emerge or some magical or theoretical structural bull market to put wind in everyone's sails. How do you outperform amongst and within all this turmoil? I think longtime Super Spike subscribers certainly know that we have long been advocates for focusing on best-in-class returns on capital or cash-on-cash returns, profitability, if you will, as well as having a fortress balance sheet. And those remain core underpinnings to what we think is a prerequisite to having sustained outperformance. But this week and in coming posts and videos, we do want to start reintroducing what has become a four-letter word, the G word, growth. And I know some of you are going to jump out of your seats. Don't you dare, Arjun, give these companies a free pass to start spending and growing like they did before. We all know coming out of the super spike era and the surging CapEx that led to underperforming projects, and then the surge in shale drilling led to profitless shale growth last decade. No one, and we are not talking about a return to that type of mindset. Profits and balance sheet health remain the priority and sort of our core grounding. But I will say there's also no doubt, especially when you look at the numbers, that investors will side with companies and prefer them, and they will outperform those that can show better per share growth and earnings or cash flow versus those that cannot. And that is the key. How can you hit the trifecta? How do you have best-in-class returns, a fortress balance sheet, but also show reasonable or top quartile, we'll call it, per share cash flow growth? And I think especially for the upstream sector where your asset life is finite, there is going to be a need for some amount of reinvestment unless you're going to liquidate or sell your company. Dividends and stock buybacks don't fall from the sky. They are a function of the profitable investments that you make. I do also want to just give a reminder, if you're listening to this on Apple or Spotify podcasts, there is an accompanying video that you can find on YouTube or on the Super Spiked or Veritin websites. And also, if you only consume the podcast or videos, we do actually do written posts in all the weeks that we do not publish a video. So there is actually a written product, all under the Super Spike banner, that you can find on the Super Spike website and on the Veritin website. So our post last week focused on this idea that with geopolitical turmoil, as we're going through now with all the hostilities, uncertainties between Israel and Iran, that the broader macro context matters. And you can have geopolitical disruption and the underlying macro can be bearish, neutral, or bullish. You have to understand the underlying context to really kind of know how to think about geopolitical turmoil. I'll show some slides in this video that sort of reinforce that point using Iraq as an example. And of course, our macro outlook at this time, our context, if you will, is that we are in a super vol, at least not yet, super cycle kind of environment. I think it's better than the 90s, but it's certainly not the 2000s kind of surging demand against disappointing supply kind of backdrop we had then. For traditional energy companies, they absolutely are geopolitical hedges. The question is, why would you only want to be that? That's an environment where something happens, oil spikes, and people rotate into the oil and gas sector, or maybe they just have some residual waiting to protect themselves in case something really goes south in the Middle East. The goal has to be, I would think, for any company that is a publicly traded company that is not looking to sell themselves, how do you become a long-term investment? And that is that trifecta of profitability, fortress balance sheet, but also per share growth. And that is the key, in my view, to reattracting real, fundamental, long-term investors. You're going to have to bring back an element of per share growth to go along with best-in-class profitability, balance sheet, especially if we remain in a super vol as opposed to super cycle type macro context. So I'd like to use turmoil in Iraq as examples of how different geopolitical disruptions or events led to very different outcomes for especially the oil price and therefore actually the sector more broadly. And the first one, and this goes back over the course of my career, there were kind of three major disruptions we've had in Iraq. The Iran-Iraq War, which also came right after the Iranian Revolution. This is 1980 to 1988. We had Gulf War I in 1990, and then we had Gulf War II in the early 2000s. But with the Iran-Iraq War, this was a major, major disruption to oil supply between Iran and Iraq. 5 million barrels a day of oil supply came off the market in just a few years. And if you don't remember, oil demand was only 60 million barrels a day back then. So it was a very material disruption. Yet it was also a time where that broader macro context was structurally bearish. Oil demand was actually declining. After the 1970s oil crises, people stopped using oil in power generation. We had negative demand and obviously recessions as well. And we had surging non-OPEC supply. Saudi and others tried to cut supply to protect the price, but it failed miserably. It was a bear market. Oil prices did not sort of as freely trade as they do now, so we don't have the graph for it. But I don't think think anyone that remembers that period or has studied it, the 1980s was not a good period for the sector, and it culminated in the 1986 major crash when Saudi again flooded the market. So here you had an example of major disruption, but the broader macro context trumped what was a very, very material outage between Iran and Iraq. The second period I want to talk about is Gulf War I. And Saddam Hussein and Iraq invaded Kuwait in, I think it was August 2nd, 1990. And that invasion led to a disruption in both of those countries' production. You can see it here in this graph. This is just Iraqi supply. It fell from, I want to say, 2.8 million barrels a day to almost zero. And Kuwait also had some amount of production that went offline. It was a very material disruption. But when we look at the oil price impact of that, and this is WTI oil prices showing from 1989 to 1991, it was a short-term spike. It lasted not even quite a year. It went to, the oil price doubled, so it was material at the time. But the broader macro context then was sort of steady, but not surging oil demand growth. We were still living off the big projects developed in the 70s, so non-OPEC supply was able to grow at a pace that could keep pace with demand. You still had quite a bit of OPEC spare capacity that also built up in the 80s. And so this disruption was sort of a one-off spike. And I don't think we're exactly in the 1990s kind of environment right now. But when I think about the current bout of Middle East turmoil, this strikes me as probably the best or closest to being the best analog. You can have meaningful spikes, but I'm going to call it to be more likely to be short-term, so long as we're still in an environment where we're having kind of negative revisions to global oil demand and either neutral or even to some degree positive revisions to non-OPEC supply. I think this to me is a good analogy for the market we're in right now. I think the third Iraqi disruption period I want to refer to is Gulf War II, which happened, 10 years later? 10 years later than Gulf War I. Of course, George W. Bush was president at the time. And from its pre-Gulf War II high, we did have a little bit of a fall in Iraqi supply. But of course, the early, most intense phases of that war went relatively quickly. It then went on for many years and decades after that. But the initial phase went quickly and the production actually rebounded. Now, at the time, the perception was the macro context is bearish. People had now been in 15 years from 1986 to 2000 of kind of modest demand growth, generally healthy non-OPEC supply, costs were coming down, OPEC was easily bringing oil on from all the spare capacity they had. And so the perception was one of bearish, but of course, as we all know, and this was the big call we made at Goldman, my team and I, this was the start of that super cycle era, the super spike call. And for Iraq specifically, part of the bear call that analysts were making was that not only can non-OPEC supply grow, but now that, the US is taken over Iraq, whatever the right language is, American and European companies are going to massively get all these oil contracts, and Iraqi supply specifically was going to go from 2.8 million barrels a day under Saddam Hussein to 7, 8, 9, 10, 11. There were some ridiculous, crazy forecasts of how much Iraqi supply was going to grow by the end of the decade, 2010. And if you look at it, by 2010, actual Iraqi production was still below the pre-Saddam or when Saddam Hussein was still running the country kind of levels. I mean, it was a remarkable failure of growth relative to what was the overwhelming consensus at the time. US goes into Iraq, it's going to be American and European companies, and production's just going to surge. And that was the theme throughout non-OPEC, Iraq, other OPEC countries, and of course, we all know China and the BRICS were emerging as well. And so what did we have? We had a super cycle. And our point would simply be, when studying geopolitical turmoil, understanding the broader macro context matters. I think there's some who believe this is what current turmoil in the Middle East is going to lead to. And I'd still say I'm not a peak oil demand person, but I am cognizant that global GDP is sluggish. China is absolutely going through some headwinds. And I'm not someone who thinks shale is about to roll over anytime soon. And when I add in Guyana and some Brazil and Canada, again, I think it's better than the 1990s, but I don't think we're in this kind of environment. And so again, geopolitical turmoil, it is that bigger and broader underlying macro context that is what matters most in trying to assess what kind of reaction function we're going to have. Now, I want to turn to putting this into companies because, again, as a company, you can't just stand still and say, I'm going to wait for a super cycle. That's ridiculous. You are trying to attract investors back to your company. And if you're an investor, you're trying to figure out which of these companies are undervalued and that the market's too bearish on for any number of reasons. I've not shown this in a while, but oftentimes when we talk about profitability, there's a notion of sector profitability. Over 100 years, a commodity business like oil is going to be a cost of capital business. It'll have periods where it does better, like perhaps the current period. It's going to have a period where it does worse, perhaps like the 2010s, but overall a commodity business. That is not true of best-in-class companies. And that has always been my focus as an analyst, as a partner of Veriton now, and in all my board and advisory work. How can you be a best-in-class company? That in round numbers means mid-teens through cycle returns on capital, irrespective of the macro. And that I want to keep emphasizing profitability because as I talk about growth, I don't want to ever get away from this as the grounding to whether the growth makes sense or not. And I'm showing return on capital employed here. I should also show the Croakey graph. I just didn't have it with me right now. I will show that in a future super spiked as well. We like both profitability metrics. So I just want to introduce right now this topic of per share growth and use a couple of examples. And I think we're going to do a lot more work on this in coming weeks and months. But I'm showing here, and bear with me, I have company A on the left and company B on the right. Now, I know that's a little annoying. These are actual companies. I do feel that since Super Spiked is public and for free, and given various roles I have, whether it's at Veriton or various board advisory roles that I have, I don't believe it's appropriate for me to use actual contemporary company examples. Sometimes I talk about companies from 20 and 30 years ago. I've talked about Exxon from Lee Raymond in the beginning of my career. I talked about XTO and all that kind of stuff. But I think for current examples, I apologize to everyone. It's annoying, but these are actual companies, but I'm going to use company A and company B. These are two companies in the same sector. And if you were to look at these companies, they are of slightly different sizes, but their macro exposures are very, very similar. I think that is absolutely true. And so in both graphs, the gray line is the stock price, the blue line is consensus cash flow per share estimates. And the stock price and the cash flow per share correlate very well. Company A on the left, again, despite almost identical sort of asset and commodity exposures, if you will, has grown their cash flow per share at a much slower rate than company B on the right. The company A on the left, the earnings, the cash flow per share, generously, it's up by a third over, this is a 2015 to 2024, so it's over a decade period. You can see company B, these same numbers have tripled, and the stock price has gone consistent with that. This is the same analysis, but we're now looking at company B divided by company A. So it's a relative performance graph. So the gray line is the relative share price performance. The blue line is relative consensus cash flow per share estimates. And once again, it's very similar to the prior graph, it is a very strong correlation or relationship, that's probably the right word, where the outperformance of company B relative to company A matches their outperformance in cash flow per share. Again, it's per share. So why did company B outperform company A despite having very similar margin and sort of commodity exposures? Some of it was good M&A versus bad M&A. Some of it was some good CapEx versus bad CapEx. Some of it was stronger stock buyback for company B versus company A. It's a mixture of all of the above. I will tell you that if you look at returns on capital, it matches this type of analysis. It's hard, again, I know, to show without the actual company names, but company B actually had better returns on capital than company A. The balance sheets are more convoluted. I'll come back to that. Our point would simply be investors have always cared about the per share growth. I think the challenge for me will be, can we find examples where the per share growth has worked out, but they somehow had bad profitability? Is there an exception that proves the rule? I'm going to say these relationships are all directionally go consistently in the same way. Best in class profitability, good balance sheet, but the per share growth element to it, I think, is a key component to having outperformance. And we're going to spend a lot more time in this in coming weeks. So I'd like to end this video on a personal note. And I did not know this, but I'm actually recording this on Boss's Day. So happy Boss's Day to my boss, Maynard Holt. It is an absolute pleasure and a joy to work with you, to work for you, and to be part of Veriton. But I want to use this opportunity to remember a past boss in particular. And I've, in prior Super Spikes, mentioned some of my key mentors, Paul Leibman at Petrie Parkman, Chris Carapi at JP Morgan, and Steve Strong at Goldman Sachs. Two of those were actually either were or became my boss. But throughout my career, especially at Goldman, I had a number of directors of research that I reported to, and I'll go with their first names. None of them, Goldman people tend to be private, but some of you will know if you work with me, Greg and Robert, Andy, Kim, David, Laura, Anthony, Suzanne, Steve, and I hope I haven't forgotten anyone. But there was one early in my career. It was actually Kim. She was our former specialty chemicals analyst, I want to say. She was only director of research for a short period of time. I want to say it was my second or third year at Goldman. I'd come from the buy side. I was new to being on the sell side, as it's called. And one of the big things was to become an institutional investor, II ranked analyst. And it was either, again, '01 or '02. I moved up from sort of nowhere to being runner-up. And I was also making some progress in what we call the broker votes, when all of our clients write down who are the Goldman analysts they like. And I was expecting a very positive performance review. So I go into Kim's office around year end. Our business unit leader, David Fleischer, is with me. And I'm just expecting her to just tell me what a great analyst I was and how much of a good job I did, and therefore how much they were going to pay me in the current year. And she starts, I was like, Arjun, well, just looking at the numbers, you've made some progress this year. I guess you're now like in the top third on these broker votes. And I see you're seventh in II. I said, wait, Kim, I've made a lot of progress in the broker votes and I'm runner-up in II. She's like, yeah, you're towards the bottom of the just below average top, of the just above average group of analysts. So yeah, you're seventh. I'm runner-up, sure, whatever. And and the performance review went on, and I probably didn't hear another word out of her. David could tell how upset I was that she was just not singing my praises for this phenomenal year that I thought I had. And we go after the review into the oil service analyst office. He's a friend and colleague and a peer of mine, Terry. And Terry's like, she doesn't know what she's talking about. You were runner-up this year. You have made massive progress in only a year and a half. I don't know what she's thinking. She's out of her mind. They better pay you, Arjun, or you should. Like one of those types of discussions. And David turned to me and said, Arjun, you were runner-up. And I know Kim kind of made fun of or kind of didn't appreciate your being seventh, but seventh is pretty good. I mean, it's hard to be top three. And it was right at that moment that I realized she was right. These guys were just supporting me, so I don't blame them, but that I was wrong. It is not okay to have been runner-up and sort of, at the bottom of the group, just below the top three group. At Goldman Sachs, it's the Ricky Bobby line. If you're not winning, you're losing. It's George Steinbrenner when he owned the Yankees. If you do not win the World Series, it is a failure. And that was the mindset, and that was her point. I think she did appreciate actually that I'd made a lot of progress, but she was not going to let me be satisfied with being just a little bit above average and recognizing that the only goal is to be the dominant analyst in your space if you're at Goldman Sachs. I think the world has moved a little bit away from this sort of tough love approach. I appreciate it. I appreciate it more now than I certainly did at the moment. I think I did come to appreciate it at some point in the years that ensued, but I do want to thank her for that feedback. And I think the question is, do we need more of that type of tough love to come back into the world? I hope my kids get it. I think as they go into their careers, they need their version of Kim Retrieve to push them along. So anyway, thank you very much. Happy Bosses Day, Maynard. and we'll see you all next week.